Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the costs of renting versus buying, my interview with NEXA's Mike Kortas on the advantages of the wholesale channel, the evolving needs of borrowers, and how technology will change the scope of employment in the mortgage industry. And with it being pretty quiet in the capital markets, let's look forward to a potential summit between Ukraine and Russia, or domestically, Fed Chair Powell's speech at the Jackson Hole Economic Symposium later this week. Thanks to today's podcast sponsor, First Close. First Close provides fintech solutions to HELOC and mortgage lenders nationwide, increases profitability, and reduces costs for mortgage lenders through systems and relationships that enable lenders to assist borrowers more effectively and ultimately shorten closing times. To learn more, visit firstclose.com. I asked a German girl if Germans are afraid of numbers. She said, 9! Numbers make up the bond market, and a steeper yield curve, which is the difference between short-term rates and long-term rates, steeper means more of a difference, tends to help banks and credit unions, since they are paying less on deposits and can lend the money out at a higher spread. Brokers and independent mortgage banks aren't fans, however, as they tend to be beat up, which is a technical term, just kidding, by borrowers doing comparison shopping. Unfortunately for any mortgage loan originator, comparing renting and homeownership isn't going so well. Ownership costs like insurance, property taxes, and assessments for condos are going up, while rents are not. Realtor.com reports that median rents declined year over year for the 23rd straight month. Median rents are about 2.7% below their 2022 peak, so rents have basically flatlined. They've increased on a year-to-date basis, however, and you could chalk that up to being nothing more than normal seasonality. The current median asking rent is $1,711, and I know that might not necessarily be helpful, as real estate is a local issue rather than a national one. Speaking of something national that I think is pretty worthwhile, for most of you, many listeners to this podcast agree that Dave Stevens was widely regarded as the voice of the mortgage industry. A rare blend of technical expertise, passion, and authenticity who led with both heart and vision until his passing. Revered across all levels of the industry, from CEOs to young loan officers, Dave listened intently, communicated with clarity across diverse audiences, and remained grounded in his belief in the transformative power of homeownership. His leadership, especially during the financial crisis, earned him a lasting place in the Mortgage Banking Hall of Fame. In his absence, many feel the industry has become more fragmented, lacking the unifying presence he once championed. As the mortgage sector faces continued challenges, including recovery from a difficult 3-year stretch and the ongoing debate around the GSEs, there's a pressing need for mortgage bankers to regroup around shared priorities. So argues PennyMac CEO David Spector in the newest series of written articles we have for you on our website, chrismancommentary.com. He reflects on his journey from Wall Street to leading one of the nation's top mortgage lenders, emphasizing the value of ethical leadership, balanced business models, and cutting-edge technology. For the link to that story, as well as the latest employment opportunities and services and tools for lenders and brokers, visit chrismancommentary.com. And yes, it was quiet again yesterday. Headlines revolved around renewed optimism surrounding a potential summit meeting between Russia's Vladimir Putin and Ukraine's Volodymyr Zelensky, as well as speculation over just what will be said during Fed Chair Powell's Jackson Hole speech later this week and how that will impact rate cut odds. We received a mixed housing starts and building permits report yesterday. Housing starts are up 5.2% month over month to 1.43 million, exceeding 1.31 million expectations. And building permits were in at 1.35 million when they were expected to be in at 1.39 million. Housing starts climbed to a 5-month high, led by the strongest pace of multifamily construction in more than 2 years, though multifamily housing starts are known for the month-to-month volatility. For today's interview, I wanted to welcome back to the show NEXA's Mike Kortas to talk about the advantages of the wholesale channel, the evolving needs of borrowers, and how technology will change the scope of employment in the mortgage industry. He's co-founder and CEO of NEXA Mortgage and has 27 years of experience in the industry, having started his career well before he launched NEXA in 2017. According to his bio, he relentlessly pushes for growth, innovation, and dominance. And some of those tenets you'll hear in our interview today.
For people that might not be super intimately familiar with the wholesale channel. Can you explain NEXA's place and kind of your strategy for why you started it and where you hope it eventually leads to?
Well, the ultimate reason we started NEXA Mortgage is due to product. We wanted access to more products, right? And products in our mind also meant less overlays. Every lender has an overlay, whether they want to admit it or not. In fact, there's overlays within lenders between their underwriters. One underwriter at one company will approve something, another one won't, as an example. And in the retail space, we got frustrated with that. I got frustrated with that. And so, because I knew there was other options and other people are closing loans up the road that I could have closed myself, but I lost them because an underwriter didn't agree with me. In the wholesale space, I don't have that problem. So I don't have as much of that problem, I should say. So we actually are predominantly non-delegated correspondent now. So we're in essence absolutely no different than retail. We are a mortgage lender. We don't like to be called a broker anymore because we actually fund more loans than we broker. But we're a mortgage lender that deals with wholesale rates is the only difference. That's the difference between us and retail, if you will. So I love the fact that you use the word wholesale because it's really what it is. It's the difference of wholesale and retail anymore because we have the same exact benefits. Right? Now, Nexo is large enough that we have our own underwriters at these lenders. They only work with us and we can get them on the phone and we can communicate with them no different than retail has the same claims. Every broker or everybody in the wholesale space doesn't have that benefit. Don't get me wrong, but we do. So we basically say we're not a whole lot different. We're a mortgage lender that gets wholesale rates. That's our biggest difference. And then we have multiple investors to choose from. So we obviously have lack of overlays, if you will. We know who does what. We disclose in our own name. So if one underwriter doesn't really see the light of day, it's very quick for me to take that entire file and transfer it to somebody else, and I don't have to wait out the trade days because the disclosures are in my name already. So it's the best of all worlds, in my opinion. But that's our niche. So.
Yeah, best of all worlds. I think more and more people are coming around to that idea, seeing the success of the wholesale channel. It's neat what you said though, in terms of it operates much like a retail operation. And I'm here to talk to you a little bit about the recent partnership with Tidalwave. But before I get into that, can you talk about what we've seen from your side of the origination space here over the last year or two, how people are winning market share, how the needs of borrowers have evolved, how tech has played into this, and just how people are, companies like yours are able to beat out the competition.
Well, companies like us are able to beat out the competition, quite frankly, because the world has evolved in technology. And certain technologies make it a lot easier for us on the wholesale side, who have much smaller margins, in order to operate effectively. Because we basically operate with limited to no overhead. We operate in a skinny environment, is what we do. And we're able, but listen, previous to like even 2015, it wasn't possible. You had to have bigger, fatter, and thicker margins in order to do things. Now, in the wholesale space, we had to learn within that. Well, technology has helped us do that, right? We were able to build out a support platform that rivals any retail level of support. We just don't do it with brick and mortar anymore. Now, with an online world, uh, even just the basics of Zoom. So that alone allows us to provide a support platform that rivals any support platform you can consider in the industry. And it wasn't until we got the support piece right that NEXA was really able to grow. The support's just too important. But that's something that the retail space controlled for years. They had better support because they had large levels of middle management and they had a lot of brick and mortar locations. We don't have that luxury. So we relied on technology. But then when COVID happened, it really, everybody went into a Zoom platform and we were able to really monopolize on that at the end of the day. So, but that's, why wholesale is able to dominate. And I really think we held ourselves back for a while by creating brokers. And I'll go back to the word brokers. Brokers create a rivalry between brokers and retail. And it was our fault for doing it. With this whole brokers are better moniker, that just draws a line in the sand and makes it very difficult for people in retail to even like us or think about us, right? So there was this barrier, a little bit of pride, even though the wholesale space is better for self-producing independent loan officers, they wouldn't come because we drew this line in the sand and caused a lot of conflict. So let's get away from that, get away from the brokers are better. Brokers aren't better. Wholesale is better than retail, but different models are different models. And so I'm just glad that the wholesale space is kind of growing beyond that. I was a big part of that too, so I was part of the problem. But we're realizing that brokers are better moniker is just not a good thing.
Yeah,
So to allow the wholesale space to grow.
I don't want to belabor the point too much, but if a line was drawn in the sand, it's almost like you're kicking sand back over that. You're kind of re-blurring the line between retail and wholesale. And I'm wondering if you can explain that a little more, how you see those two channels working together from an origination perspective as we move forward.
I don't know that you're gonna change it from an origination perspective. Companies with full retail operations are going to constantly defend retail. Their management teams have no choice but to do it. However, there are a lot of companies who have a wholesale space, right? Those same exact companies who do retail also do wholesale to us in a TPO environment. But so a lot of those companies will work with us as well. There are companies who don't do wholesale at all. They only focus on retail. You're always going to have that conflict between those companies and somebody like me who does wholesale. But then you have other companies who do both, right? So they have a retail division and a wholesale division that focus on people like me in a TPO channel. And so I don't think you're ever that sand's going to keep getting kicked over at the end of the day. It just doesn't have to be as bad as it was. So when you get rid of these real hardcore lines, these really aggressive stances, then human nature kicks in and people start to listen to each other a little more. But I mean, 4 years ago, a retail loan officer is just simply not even going to listen to a broker talking like that. It's just it's too much conflict. They're like, arrogance gets in the way and all that stuff. And they're just not even going to listen. So the line in the sand was never going to go away. I like the line being blended more now because you can realize, and so some of these loan officers in the retail space can now look and go, well, wait a minute, let me reassess this because I can literally go to the wholesale space, use the same company I currently work for, but now I have access to 280 more companies and their different products as well. So, but it's really, I believe the reason that the TPO channel, the wholesale space, if you will, can't grow or couldn't grow as fast as it could is because of these arguments that we created. So we need to get rid of those, in my opinion.
Well, you've also created a nice economy of scale with your over 3,200 loan officers. There's still shops out there relying on paper forms and phone tag with borrowers and those sorts of things. And I guess in essence, you and I are here today to talk a little bit about your new partnership with Tidal Wave, with which people that are familiar with our commentary or the podcast would have seen Tidal Wave throughout last year and this year. But it's really helping automate a bunch of different areas, whether that's compliance stuff, whether that's income verification, whether that's pre-approvals, whether that's language AI support. There's a ton of different aspects that it's helping automate. And can you explain why, just the reason for the partnership, and then go into at least high level what it will allow you to do and how it allows you to better support your origination team or your loan officers?
Yeah, well, you and I agree on this. It's AI is doing a lot of things for the entire mortgage industry. I believe Tidal Wave is the best current outfit for the TPO side. Now, there's reasons for that. We've been reaching out for the long time, long, high, and wide, to different AI companies. The vast majority of them will not and do not entertain a broker environment or the wholesale. They'll entertain wholesale if you're funding the loan, but not if you're originating the loan. So they're basically large and wide excluding brokers from their conversation entirely because they don't see a marketplace for it at all. They just can't see it because we are fragmental. We're fragmentalized. There's loan officers everywhere. We're dispersed. They have too much choice. You can't force it, if you will. Where retail is able to, IMBs, I should say, instead of retail, IMBs are able to direct that traffic a lot better. Now they are focusing on some wholesale funding companies, right? And a lot of the companies we work with are focusing on AI, but they're all focusing on underwriting. They're not focusing on what we do, and we focus and specialize just in the origination platforms. And then, of course, we rely on our lenders that we work with to underwrite those loans. So that's what everybody's focusing on because the money is generally on that side of it. So we couldn't get really anybody to listen to us. But Diane over at Tidal Wave was skeptical at first. She's like, help me understand why you're even my client, right? And so we were able to get her to understand that. We were able to talk to her in dialogue. We went out and met with her. And then, she would realize that there's an entire marketplace that's potentially being missed out on. And we're particular fans of Tidal Wave because they believe in the consumer first environment. They're starting from the front side of where a loan starts, where everybody else is generally focusing on the underwriting side of it and or the processing side of it. So when you started with the front end side of it, that became much more realistic for what I do as TPO. We are more focused on the consumer side, while we kind of rely on our lenders on the backside to underwrite properly and their systems for that. So it worked out really well for us. Now they're still working on the whole thing because they do have their IMB partners. Don't get me wrong, but she was able to see where that's important on the front side. And realign some of their business models. And so our partnership is going to help them understand that part. And it's exciting for me that they were so open to it. And we talked to a couple of companies who became open to it after we showed them there is a marketplace for this and you can make money off this type of a model. And so the people who were willing to change and listen were great. It's the ones who wouldn't. They just said, no, that's not our model. We're going to continue with our model. Fine. Good for them. They'll continue the underwriting model, which in my opinion, by the way, as many AI companies are working on this model, it's a little congested. Now it's becoming congested. So the fact that Tidal Wave already had a focus on the front side was important to me also. So it really has become a pretty good partnership, symbiotic partnership between the two companies because of where our focus is on. So
Yeah, I think Diane is an incredibly smart individual, and have an originator at the scale that you're able to lend on and have that partnership. So I wish y'all both continued success with that. It seems like we're finally reaching this inflection point of people that get it are going to start pulling away from the competition, aka those that are mired in the past. And I'm wondering where you're still seeing. And maybe you're not the right person to ask this because you're marching forward and you're not looking in the rearview mirror too much, but where you still see people kind of mired in the past and what they're not able to wrap their heads around, that you feel like you is clear as day to you and makes perfect sense as the industry moves itself forward.
yeah, I mean, those are the people that I absolutely know that in a couple of years will be gone. There's a lot of people are worried, oh my gosh, it's going to take jobs. It's not going to take jobs. It'll actually create jobs. It's not going to make us less busy. It's going to make us more busy. But the jobs that we currently have might be less. It's going to create other jobs in different ways. So for example, I don't think the industry is going to need maybe 50% of the current loan officers that it actually has right now, even as the industry gets more volume. It won't need as many loan officers. You're going to need about 10% of the underwriters, maybe. And you're going to need none of the processors. They'll all be gone. They won't be needed anymore. However, right, there's other opportunities and jobs out there. If somebody's still stuck in their ways, and that's usually an age thing, then and they won't want to learn the AI, they won't want to get involved in it. They're afraid, no, I'm going to do it my way, a little bit of stubbornness. Well, that's going to become your next Walmart greeter, unfortunately, because there's not going to be a place for them. But people who will embrace it, the companies who will embrace it will do well. Now, small companies are going to have a disadvantage here. Small brokers, let's say, will have a significant disadvantage. And I don't know that they're going to make it, or they're going to struggle. That's for certain, because they're not big enough for these AI companies to worry about. AI technology is expensive and has to be paid for still. Now, it's cheaper over the long time because it replaces so many things. But those companies may not listen, and they may want to continue to do it the old way. They have no choice but to merge in with the biggers, to merge in, to be acquired somewhere, and to figure out a way to survive in those environments with somebody who can do it. But as I tell my loan officers, none of you have to learn AI. Do exactly how you're doing business now, so long as you plan on retiring within the next 2 years.
Mm-hmm.
Because they won't be around anymore. So you're going to have to learn to adapt to it. I'm a firm believer that in 2 years from now, a loan officer's primary function is going to be an influencer. And I personally believe that younger people in the industry are going to succeed more than somebody in the industry for 20 plus years. doing loans. Somebody slinging loans for 20 plus years who has stuck in their ways are going to be replaced by that mid-20s-year-old person who understands social media really well, who understands influence, and who thrives in getting out there and meeting people and doing those things. Though it's going to be a matter of how many people can you get into your system rather than what your knowledge of FHA guidelines are, because AI will take care of all the knowledge base.
Yeah. So let's talk cost to originate then, because some of the chatter is, hey, we're paying too much out in sales commissions to people. However, I would argue that if you can alleviate a bunch of the other parts of the process, you don't need to lower sales commissions. In fact, I think that you've seen with I think you've seen with processing efficiencies here, you've been able to save in the 4 figures per loan. And so I'll kind of ask you the open-ended question of, how do you see sales compensation evolving over time? That it'll stay relatively the same in terms of a percentage because we've saved in other places? How do you see it evolving?
So personally, I think, and I can speak of the TPO side, but I personally think that loan officers that embrace AI and that are with companies who embrace AI early are going to have a windfall of income over the next couple of years, because they're going to put in this AI. It's going to take care of everything. They're going to have more time. They're going to be able to put more people into their pipelines, and they're not going to change their margins or need to change their margins. Now, as more people get into AI, and because loans are going to be easier for us to do. I mean, my work as a loan officer, I've been in this industry for 27 years, and I remember doing loans. There's a lot of paperwork, a lot of steps involved. It's a very long-term process to get a mortgage actually done. It's actually a pretty large transaction, right? When at the end of the day, but AI is going to automate so much of that it's going to become easier. And initially, loan officers will do really well in this environment. They will make a lot more money with AI than they're currently making. The difference is going to be once it's widely adopted. And once it becomes widely adopted, and it's so easy to get a file through, or you just got to keep flushing it with people and new prospects, you will get people start to reduce their margins to compete. And then I think you see a reduction. But I don't think loan officers are going to lose income. They're just going to do more files, less income per loan over time. But they'll still make the same income or more than they make today, is the reality.
Yeah, I know you have a lot of really intelligent people around you. Does anybody bring up points that might go against the way you see things? You say, they might have something there. I need to incorporate this into the way I'm thinking. What kind of counterpoints have you either taken into account and you feel like you move past them, or you're still noodling over how you can address them as you go for more and more volume?
So the biggest one that I get is adoption. People say that, well, people aren't going to adopt this. They're not going to adopt it right away. And so I ask you, okay, well, how did you adopt Amazon? How do you adopt talking to Alexa? How do you adopt, like, I don't dial a phone number anymore. I literally say, I hold the button down and I say, hey, call so-and-so. And it just calls for me. I don't type a button in anymore. And so this is becoming more and more common. It's a point. People think, well, nobody's going to adopt it. Nobody wants to talk to a computer. But all the data shows that that's not correct, and people are adopting it more. Right? We don't go to the store to pick something up. We DoorDash it. Convenience is important, but it's adoption. I was in this very same discussion that you're talking about a few weeks back with a very productive loan officer, right? A good loan officer, productive, smart individual. And his argument is that loan officers aren't going to do it because they're lazy and they want somebody there. They want a human to assist them, right? A realtor wants a human to assist them, those types of things. I'm like, wait a minute. What you don't understand is that's the exact reason you're going to do it, because it's easier than that. Loan officers are going to get rid of their LOAs, their assistants. They're not going to need them anymore. They're going to log in. You're going to log in. Your customer is not going to call you asking for an update. They're going to log into the app, or they're going to log in online, and they're going to talk to the loan. And it becomes so easy just to ask the loan, hey, how's my file going? What do I still need? What's next? It will tell you exactly what's next. The realtors, they'll log in. They'll have their own login. Right? Okay, talk to the loan. The underwriters will talk. Everybody will talk. Nobody's going to call the loan officer or the processor asking for conditions anymore. They're going to tell the loan what they need. They're going to tell the loan, and the underwriter can go in and tell the loan, well, I'm going to need this. And the loan will say, well, let me go get it for you. It will text the client. It will actually call the client and it'll go get it. And the client can, now if the client wants further clarification, the loan will connect you to the loan officer, right? To get that human interaction. So loan officers will still have to give those explanations. But large and wide, people will learn to just talk to the loan. It's easier, it's faster, it's always available. It's available at 2 a.m. It doesn't get a headache, it doesn't take time off, it doesn't go on vacation. And your realtors, your consumers, and everybody involved are going to know that. So it will become easier. I disagree wholly with that. It won't have adoption. Technology always gets adopted over time. Look at history. Everybody said internet's going to put us out of jobs. Well, I'm pretty sure we're busier because of internet than putting anybody out of work. So, as an example.
Yeah. I'm with you. It's interesting, and hopefully this doesn't get replayed in 5 or 10 years, and I sound naive for saying this, but over
Both
time,
of us.
both of us, yeah. You look at the companies that have dominated mortgage. You go back to pre-financial crisis. You look at WAMU or Countrywide, or in the wake of that, you had Wells Fargo, you had Chase, you had these big players. It evolves to where now it's UWM and Rocket, and I would naively say, I think companies in this super technological, super digitized end-to-end mortgage era are solidifying their gain, where it's going to be a heck of a time for other companies to knock them off the top. So it's neat to see what you're doing. It seems like you're certainly building something where your staying power is growing greater and greater. I appreciate the time, Mr. Kortas. Thank you very much.
Thank you.
Today's economic calendar kicked off with mortgage applications decreasing 1.4% from 1 week earlier, according to data from the Mortgage Bankers Association. Later today brings an auction of $16 billion of 20-year bonds and remarks from Fed Governor Waller and Atlanta President Bostic. In between speakers, the minutes from the July 29th and 30th FOMC meeting will be released. Outside of the U.S., we received 2 central bank decisions ahead of the open. The RBNZ, which cut rates 25 basis points, and the NEXA Bank, which left rates unchanged. We begin the day with agency MBS prices slightly worse than yesterday's close, the 2-year yielding 3.76, and the 10-year yielding 4.31 after closing yesterday at 4.30%. Let's wrap up with a joke and some housekeeping. A high-powered attorney landed in the hospital for a few days and quickly became every nurse's worst nightmare. He barked orders like they were his personal staff, complained nonstop, and generally made life miserable for everyone. Except for the head nurse. She wasn't about to put up with his nonsense. One afternoon, she strolled into his room with a clipboard and said, "All right, sir, I need to take your temperature." He groaned, griped, and muttered under his breath for a good 5 minutes before finally relenting, opening his mouth in defeat. The nurse shook her head and said, "Not that way. This time we need a rectal reading." The lawyer let out an even louder string of complaints, but eventually, with a dramatic eye roll, turned over and begrudgingly exposed his backside. The nurse inserted the thermometer, patted him on the shoulder, and said, "Now, stay exactly like that. I'll be back in a few minutes." As she left, she made sure to swing the door wide open for anyone passing by to get a good look. The big shot attorney stewed in humiliation as people walked by, chuckled, and whispered. After about 20 minutes, the doctor walked in, took one look at the scene, and asked, "What's going on here?" Red-faced and furious, the attorney barked, "What's the matter, Doc? Never seen someone getting their temperature taken." The doc raised an eyebrow, leaned closer, and said dryly, "Not with a daffodil." Thanks again to First Close for sponsoring this week's podcast. Provides fintech solutions to HELOC and mortgage lenders nationwide, increases profitability, and reduces costs for mortgage lenders through systems and relationships that enable lenders to assist borrowers more effectively and ultimately shorten closing times. To learn more, visit firstclose.ai.